This is the international news. I am Damilola Ade-Odiachi. And we'll start off with Europe. The European Union will set out emergency plans on Wednesday to reduce gas demand within months, warning that countries that without deep cuts now, they would struggle for fuel during winter if Russia cuts off deliveries. Europe is racing to fill its gas storage ahead of winter and build a supply buffer in case Moscow further restricts supplies in retaliation for European support or for Ukraine in its war with Russia. Russia's Gazprom has already halted deliveries to some EU states, and EU officials have warned that further cuts are likely. The European Commission is set to urge countries to prepare for such a scenario by slashing gas use. A draft of the EU plan would propose a voluntary target for EU countries to cut their gas demand over the next 8 months. This could be legally binding if Europe really faces a gas supply emergency. Now, oil prices edged down on Wednesday, pressured by global central bank efforts to tame inflation and ahead of the expected build in US crude inventories as product demand weakens. Brent crude prices for September fell about 37% or 0.3% to $106.98 a barrel by 3:40 GMT. That's 3:40 Greenwich Meridian time. While US West Texas Intermediate, that's the WTI crude, for August slipped 69 cents or 0.7% to $103.53 per barrel. The WTI contract will expire later on Wednesday. Now, the more active September WTI contract was at $100.24 a barrel, then it's also down 50 cents. Oil prices whipsawed in the previous session, caught in a tug of war between supply fears due to Western sanctions on Russia and pressures on indications from central bankers that there will be a raise in the interest rates to combat inflation. Now over to China. China has been speeding up approvals on new coal-fired power plants, and this is in the middle of increasing risks of electricity shortages, and this is according to research from Greenpeace. Adding generation capacity for its mainstay fuel has been a tried and true strategy for China during its rapid economic rise over the past 3 decades. The pace of new approvals quickened in late 2021 and early this year after power shortages crippled the economy in the fall. But China's power problems have nothing to do with not having enough generation. In fact, there's already an overcapacity of coal power plants, and this is according to Greenpeace analyst Wu Jinghan. To solve the problem, the government needs to focus on things like grid integration and energy storage. Continued emphasis on new coal plants will only distract from the real solutions, Wu said. India eliminated a levy on gasoline exports and cut windfall taxes on other fuels less than 3 weeks after they were imposed, driving a rally in the share of the nation's #1 fuel exporter, Reliance Industries Limited, and top crude explorer Oil and Gas Natural Gas Corp. New Delhi reduced the windfall tax on diesel and aviation fuel shipments by 2 rupees, this is 3 cents a litre, and scrapped a 6 rupee per litre levy on gasoline exports. This is according to a government notification. Now on to the next story. We're over in the United States. The US says that Mexico's nationalist energy policies violate North America's free trade deal and has requested dispute settlement talks under the agreement. This is according to people with knowledge of the matter, who also showed a government statement to Bloomberg News. Mexico's moves to prioritize energy from its state utility over private renewable companies, as well as denials and revocations of US firms' abilities to operate in the country's energy sector, are among the issues raised, according to the statement. The US dollar retreated further on Wednesday as the euro extended its overnight bounce on relief Europe might avoid the worst fears concerning energy shortages and on the chance that the European Central Bank may deliver a more aggressive rate hike. Russian gas flows via the Nord Stream 1 pipeline are seen restarting on time on Thursday after the completion of scheduled maintenance, Reuters reported on Tuesday. And that's it for the international business news. I'm Damilola Ade-Odiachi, and we'll be right with you after this break. The Nigerian National Petroleum Company, NNPC Limited, has approved an upward review in the pump price of premium motor spirit, that's PMS, from 165 naira per litre to 179 naira per litre. This is effective from Tuesday. NNPC, in a notice to fuel marketers, directed them to change the petrol price on pumps to the new price, which is effective today. This was even as the company equally increased the ex-depot price from 148 naira 17 kobo to 167 naira per litre, and this came after weeks of petrol scarcity resurfaced across the country as fuel retailers were adopting different price bands to force unofficial deregulation attempts. Nigeria's Deputy Petroleum Minister said this about the nation's oil industry.
The nation's petroleum industry is no longer rudderless. Nigeria's oil and gas industry lost about $50 billion worth of investment. In fact, between 2015 and 2019, KPMG states that only 4% of the $70 billion investment inflows into Africa's oil and gas industry came to Nigeria, even though the country is the continent's biggest producer with the largest reserves. We are setting all these woes behind us, and a clear path for the survival and growth of our petroleum industry is now before us.
Now, still with us is Dr. Bongo Adi, lecturer at the Pan-Atlantic University. Now, developmental partners have urged Nigeria to deregulate the petrol price in Nigeria. Is this hike linked to that, or is it just the reaction to the current market situation? So, developmental partners have urged Nigeria to deregulate the petrol price in Nigeria. Is this hike linked to that, or is it just the reaction to the current market situation?
We can see that gradually the deregulation of the pump price that everybody has clamored for is already being taken care of by the market situation. I think subsidy has been one of the hotly debated issues in current times in Nigeria. The state, given the increase, galloping rise in price of petrol globally, it's obvious that government can no longer continue to show that burden of subsidizing petrol. And again, research upon research has shown that the subsidy doesn't really work for the generality of the masses. Of course, that's not what many people want to hear, because in a country that's facing collapse across key sectors where government presence is actually not seen, there is almost no public service, public work, or whatever, functioning efficiently anywhere. Our universities have been comatose, been at home for getting to a year now. Lecturers are not being paid. So it's actually very risky to talk about subsidy removal. But of course, the market situation is such that there is no way government can continue to pay lip service to all of this. So what has happened is that from all indications, the only way government can continue to, bring fuel into the nation, and of course, stem the tide of angst, anger, and the recrimination that may arise from the populace will be to find kind of a middle ground. And that middle ground will be to remove some bit of it, of the subsidy. And in this case, what I think has happened is that the equalization fund that government used to apply in order to, bring the pump price to similitude everywhere to parity, has been removed. So in the past, when fuel lands or petrol, the product lands in Lagos or any of the ports, okay, so that's the landing cost. Now the transaction cost, in the sense of whatever it takes to transport the product to the different regions, will be taken care of by the government. But now it appears that has been removed. So, for instance, Lagos is very close to the port, so Lagos has a very small margin when it comes to the transportation cost. The Southeast has a kind of higher one. Then if it's going to the Northwest, that's also very high. Okay, so it means that regions will have to pay different prices for the fuel.
So one thing,
which is
yes. So incidentally, the Central Bank of Nigeria's Monetary Policy Committee has met and has moved the lending rate up from 13% to 14%. Now, another thing that we have to note about the increase in the price of fuel is that it is inflationary in a way. It's like cost push inflation. So why does there seem to be no symmetry in like the policy moves? What is really going on?
Well, if you're following international events, you see that every country in the world is facing a very severe inflation bout. So Nigeria's situation is not peculiar at all. Actually, compared to other countries, I think we're not that badly hit. I know many people would not like to hear that, because why people always ask why this kind of comparisons, but it is important to bring this up. The inflation is actually the attitude of the central bank, if you ask me, is a sterile move. Would it help to manage inflation or to bring it down? I can categorically tell you that it will not work. Why? We have, like you mentioned, a cost push inflation, which is coming. What are the push factors? We have exchange rate. We have the international oil price, the global oil price. Now, what is driving all of this is the Russian-Ukrainian war, which has increased the cost of so many things, and the cost of food as well. So, given that, it's not, if central bank monetary policy can work when you have a demand pull inflation, not a cost push inflation. So if it is demand pull and central bank raises the rate, that's the anchor rate, then it has the effect of, passing through the incentive for people to reduce their demands, and then over time inflation will reduce. But in this particular case, that is not the situation. No. So yes, what it means that the average consumer is facing a double whammy of rising interest rate costs as well as the inflation coming from the increase in the pump price of gasoline.
With the newly refurbished NNPC and an official pump price in place, will there be proper regulation in terms of the distribution of quality PMS, long-lasting end to fuel scarcity, stability in price and operations, and more revenue accruals to the coffers of the government, including proper auditing and documentation?
Well, you asked me a very difficult question that there's no way I can answer right now, because the monster we are dealing with. But anyway, I think there's a clear direction that we will be looking at, which is NNPC will be operating as a profit-making company. So if it is to be a profit-making company, so there is no way that it's going to, continue to accommodate all these inefficiencies, maybe pump price regulation or whatever. So they have to mark themselves to the market. So if they have to mark to the market, then it simply means that if oil price goes up, pump price will definitely go up. Okay, so we're not going to see less of this. We're actually going to see more of it, because that's the only way that they can justify investors' funds, especially when they now float on the stock exchange and people buy into their shares. They will now need to pay dividend, they will need to make returns, and they have to account to their shareholders.
Yes, so that means thank you so much for that. We've run out of time, unfortunately, and thank you so much for joining us. We'll take a quick time out, and when we return, It will be the NC4 to watch. Stay tuned.
And on NC4 to watch, these are some of the stories that we are tracking as of now. Now, the official currency rate set by the Reserve Bank of Zimbabwe has risen to 403.40 Zimbabwean dollars versus the US dollar, a trend that experts attribute to market factors. According to a trade statement made public after the conclusion of business on Tuesday, this week's exchange rate was 3.03% lower than last week's rate of 391.53 Zimbabwean dollars. As a result of the government's promise to set traders set exchange rates based on affordability, market observers feel that the present fluctuation in official exchange rates is a reflection of market forces driving developments. Meanwhile, Zimbabwe cut the price of gasoline, also called petrol, for the first time in 6 months by reducing the pump price by 0.3% to 675.35 Zimbabwean dollars per litre with immediate effect. Diesel will retail at 714.45 Zimbabwean dollars per litre from 714.91 Zimbabwean dollars. That is Zimbabwe Energy Regulatory Authority saying that in an email on Tuesday. The last time the Southern African country reduced local currency prices was on January 6. Now, the International Finance Corporation is channeling billions of shillings into Kenyan small businesses and women-owned enterprises through strategic loan partnerships with banks, plugging a gap in the local credit market that remains weary of risk SMEs. The international financiers' exposure to local Tier 1 lenders through debt and equity totaled 105.8 billion shillings at the end of 2021, comprising mainly of medium-term credit facilities that are also backed by fellow development finance institutions. And finally, the Egyptian Exports Council of Building, Refractory, and Metallurgy Industries revealed that the sector's exports have reached a value of around $3.177 billion from January until the end of May, Aram Grant reported on July 19. The sector's exports during the January to May period in 2021 recorded $2.345 billion. Now, exports of the sector surged 36% during the first 5 months of 2022 compared to the same period a year earlier. And that's it on NC4 to watch, and that draws to a close our show for today. Do not forget that you can join our social media platform, that is at News Central TV. You can also visit our website www.newscentral.africa and also download our mobile app on App Store and Play Store. Until some other time, I am Nick Onobanjo. Have a beautiful day.